You're listening to Shorr Solutions, the podcast, where our expert consulting team steps behind the mic to share some of the strategies and solutions we implement for aesthetic practices nationwide. With decades of combined experience running and coaching aesthetic and medical practices, we bring you the guidance that strengthens operations, elevates profitability, and supports long-term growth. This is where solutions begin.
Hello and welcome back to another episode of Shorr Solutions, the podcast. I'm your host, Cristian Devoz, one of the partners and a senior client success manager here at Shorr Solutions. And today I have with me a very special guest, the man, the myth, the legend, Mr. Jay Shorr, our CEO and founder, and someone who brings over how many decades, Jay? Like 4 or 5 decades of experience to the industry?
Don't make me that old, but yes.
Half a century of experience, Jay. It's amazing. We're very excited to have you on the podcast today.
Thank you. It's always a pleasure being a guest on my own podcast. This is the true sign of succession planning when my team ends up taking over what we built.
Absolutely. We're all very excited. All right. So today we're going to have a little bit of a very interesting conversation. It's going to be about cash pay only versus financing options. And this is a question that comes time and time again with our clients. Should I offer financing options? Should I just do cash pay? And which of these actually improves profitability? So the conversation is going to be all about, should you do it? And if you're going to do it, what's going to be the best for you? So with that being said, let's dive into the conversation. Jay, I guess the main question here is going to be, does offering financing actually increase total revenue, or does it simply shift lower quality patients into the pipeline?
So before we can actually give that answer, we have to define what is a lower quality of patient versus a higher quality of patient if you're performing the identical procedure. All right. If you're speaking about a lower quality of patient defined by lower revenue, that's one thing. But there is no low quality of patient. Every patient must and has to be treated identically and thought of the same way, whether they are cash pay or whether they're financing. The quality of the patient, maybe you're speaking about the quality of the profitability. And I think that's what most people want to ask. So my answer is no, it does not lower the quality of the patient.
Jay, how does it actually affect profitability? Let's get into the numbers.
Okay. When we define financing, there's several different types of financing, yet most practices only refer to financing as third party. Whether it is an Alpheon or a Cherry or a Care Credit or different types of third-party patient financing. But credit cards is a method of financing as well for the patient. The difference is they may not get X amount of free months unless they go in with a interest-free credit card for a period of 3, 6, 12 months. And then, of course, the practice still has to pay that merchant processing fee, which is usually lower, if not always lower, than the traditional third-party financing that we're referring to. But does it reduce the profitability? Well, the answer could be any charge, any fee against our retail price of something lowers the profitability. If it is a credit card and it's a merchant processing fee of 2.5%, 3%, which is a one-time fee versus the traditional 6 months free financing from these third-party lenders, or a year free, you still have to pay. The patient may not have to pay, but you as the vendor, you as the surgical practice or med spa practice still have to pay. So what you have to do is weigh out your options. Which is the least expensive expense to you? Because remember, every expense lowers profitability.
Absolutely. That's a very good point. It will affect profitability because anything like that is going to be a business expense. But is there like a trade-off? Should I do it still? Is it worth me paying all these processing fees, me paying all these rates, is it worth the increased case acceptance? Or do those fees quietly erode all the profit?
All right. Well, now you have to weigh out, would I otherwise or possibly not have gotten the patient's acceptance had it not been for financing? Now, there are trade-offs. You can have one fee for a cash pay and another fee for credit card and or third-party financing. And that additional fee would basically offset the cost that you have to pay to either the credit card company or to the third-party lender for the pleasure of the patient financing that procedure. However, you may not have gotten that case, that surgical patient, if you didn't offer that, because many other practices are. And therefore, what made you any different? Your surgical skills? Yeah. And I'm probably going to say that is what makes you different. However, does the first time patient know that? The second time patient does. The third time patient does. The referral patient does. However, the person that comes to you and wants to have that procedure done and doesn't know that, and it's between you and somebody else that offers that financing, remember, these are some pretty troubling times right now financially for people. I don't want to get into the right and the wrong, other than no matter what administration there has been recessionary economy and inflation. I don't want to get into that. However, it is a fact. And therefore, those financing options can be very attractive to the buyer, especially now as we're approaching the holidays. You have Hanukkah, you have Kwanzaa, you have Christmas, you have all these different holidays. And that's when people spend money on family and gifts and things like that. So their expendable income may not be there. So if they really want that procedure, they may need to finance that and bring them over a year, 18 months, 2 years, or you may not otherwise get that procedure. So me personally, I would always offer financing and maybe take a little bit less profit than no profit at all.
That's a great point, Jay. And as business owners, that's the mentality you have to have. You have to understand that a business has expenses, and sometimes you have to spend a little more somewhere else to be able to be profitable in other places. And a great example is, with Costco. They do offer those hot dogs, right? And they never increase the price. And maybe it is a losing proposition to them, but it's attractive to the customer, which means that they will keep coming back for that promotion and they will buy other things as well. It's the same for your practice. You want to have options for the patients.
You know what I love most about this? You came to America, you stayed with me, I took you to Costco, and that's what you remember, the hot dog.
The hot dogs, yes. Hey, I'm always, these are little marketing tricks that I always look out for.
They do not make money on that hot dog and soda. That is a fact. It is a lost leader, and they don't make any money on the barbecue chickens for $4.99, and they'll never raise their price, but yet it keeps people coming in for buying more. And that's the idea of financing as well. It keeps the patient in your practice and purchasing more.
Yes. And from a sales training perspective, I also see it as an opportunity to overcome an objection, because one of the objections from the patients that you're going to hear is it's too expensive, or I don't have that much money right now. Then you can always use the financing as a way for you to address that concern and to be able to still get that patient booked. So in a business, you're going to have expenses, but you have to understand how to, for example, offset some of those expenses. Jay was talking about, you could increase the price a little bit for those patients that want to do financing. That way you offset what you're going to pay as a business.
You have to determine at what level and at what ratio of profitability you're willing to ascertain or give up.
Right.
You may not want to pay the merchant fee, the investment of having to pay the financing fee, or lose $5,000, $10,000, $15,000. Yes, when you're doing a $10,000, $20,000, $30,000 surgery and they're charging you 3% and 4%, and you're having to pay that kind of money, you may not otherwise have gotten that large surgery. So maybe you make a little bit less, but it's better than not making anything at all. I wouldn't do it to the point of me losing money. Let's put it that way.
So there is a balance, and understanding your numbers is going to be key. Now, let's talk about the patient psychology, because we're seeing things from the owner's perspective, but what about the patient's perspective? Do financing options attract more committed patients or encourage impulsive decision-making that leads to cancellations and refund requests? What are your thoughts on that, Jay?
I think financing is a very attractive offer. And I think where it really comes to is when the patient care coordinator or whoever it is that has and engages in that dialogue with your patient, that they offer the patient options. And the options can be, when you're speaking to the patient, we offer payment terms such as cash, bank check, credit cards, and patient financing at 0%. Are any of those options attractive to you? Now, let me share why I say it like that. Many times a patient may be embarrassed to ask you about financing because they think you might look at them as being poor or not being able to afford the procedure, or they may feel that they're wasting your time. But when you open up that dialogue to the patient and you share that you offer that and ask if any of those are attractive to them, you're not putting them on the spot for the financing. You gave them maybe 4 separate options. And let me give you an example. When it came time for my wife and I to recarpet the house, I went to a flooring company, and it was not inexpensive because I looked at the carpet and I loved the plush carpet. But then they had the very thin padding. And I'm getting older and I don't want plantar fasciitis because my house is tile. It's not carpet. The bedroom is carpeted. Certain rooms are carpeted only. In Florida, you don't carpet your whole house. And then I wanted a certain type of padding. So he brings out the low padding, the medium padding, the super duper duper padding. And I said, that's what I want. And of course, the more that you want, the more of an investment it becomes. And he said to me, you know, we have a promotion that you can get X% off of the price, or you can get free financing for 18 months. I don't need free financing for 18 months. But when I thought about what free financing for 18 months meant on that number for free, I took it because it was a very good market. I saved that same amount of money. I invested it into something else and made triple my money by allowing them to finance me.
Yeah, and it was a no-brainer, right?
People have to be very careful about some of these financing options. Although it says no interest, it doesn't mean that you don't make a payment. There is a qualified payment every month. And if you miss a payment, if you're late, you will pay all the interest from $1. So does it attract the lower element in clientele? The answer is no, it doesn't. It offered an opportunity that I went with them because they offered it, and they offered the same identical, tangible item. However, in a plastic surgery practice, a carpet and padding is not a carpet and padding and a carpet and padding, because in a surgical practice, it is the quality and the expertise of the surgeon. One surgeon's skills are not the same as another. Yet that carpet I could have gotten at 3 different stores. This happened to be the best opportunity for me. So I was just using that as an example.
Now, you mentioned something that makes me concerned, and it's that you said if a patient misses a payment, they might get all this interest, or maybe at the end of a period, maybe 6 months without any interest, if they haven't paid the entirety of that, financing that they're getting. Wouldn't that open it up for risk for your practice? And
no, not for the practice. It opens it up for risk of the patient, because understand, once the patient has been approved for the financing, the practice is paid 100% in full, and there is no obligation to the bank, to the patient financially anymore. Then it's between the finance company or bank and the patient, not the practice. However, the patient may take it out on the practice saying, I didn't know that. So it is very important that all of the terms and the conditions are fully explained to the patient. It's kind of like an op note, all risk and complications and adverse, contraindications have been explained and the patient elected to proceed. I also do that with patient financing. All risks and financial obligations have, been explained to the patient, and the patient has elected to proceed with financing. But you have to educate the patient, because it can come back to bite you if what you were sold as a patient was free, and then all of a sudden you're indebted for a couple more $1,000s, and they feel that the practice may not have explained it properly.
Correct. So that's what I meant when I said risk, that the patient might take it out on the practice and they might have a really bad review for the practice or damage the image.
Well, Cristian, I had a document that I had a patient sign when it came to financing. Not just the financing agreement that the third-party lenders give, but I had one additionally, and it shared that, and it was no differently than the post-op notes and all the consents that you give the patient a copy of. They understood and initialed it to us, that they understood all the terms and conditions of their financing.
That was interesting. Yeah, I'm glad that you did that. That's a really good way to be able to solve that concern.
Let's take a quick break. Over the years, you've transformed countless lives through your expertise and dedication, giving your patients newfound confidence and joy. But every journey reaches a pivotal moment, time to ask yourself, what's next? At Shorr Solutions, we help practice owners like you identify the right time and steps to transition from practice ownership. If you're thinking about the next chapter, schedule your free consult with our team to get started planning a successful exit strategy.
Credit cards are really the best way to go, accepting it, but there are two major concerns with that. Number one, a patient's credit limit to have that procedure may be exceeded by the fee of the procedure or surgery, because their credit line may not be high enough, or they may be maxed out in order to get another interest-free credit card. But you see, the practice may end up paying 3% max, all right, on the merchant processing fee, but then they're paid, and it's between the patient, all right, and the credit card company. But unfortunately, credit card companies' interests are anywhere between 19 and 27%. Not a worthwhile thing to use your credit card for.
Right. And I know that, there is a website called creditcards.com. We don't necessarily promote them or anything, but in there, you can direct your patients to get some of those credit cards, and they can be free of interest for up to a certain number of months. It could be a year, 18 months. It depends on what credit card they get. And then once they get it, they can get the procedure, in your practice.
Yeah. Now, there are certain practices that in-house finance, which means they hold the paper. Now, let me share the good and let me share the risk. Everything is a risk. The good is that you may be able to book that case very quickly. Here's the risk. You legally can't charge interest, all right, because you are not a registered financial institution. All right, so you're not allowed to charge interest in a lot of the states. So what do? You upcharge the cost of the procedure. However, what are you going to collateralize? So if it's a $20,000, $25,000 case, all right, people used to freak out when you used to hear that years ago. $500, $7,500 was a lot. Now there's cases. We have a client that charges $75,000, $100,000, $125,000 for a case, right? So you can hold the paper and you're at risk. So you increase the price of the procedure so that when they pay it off, you have made money. All right. So, but it's risky, because what are you going to do if the patient stops paying? Now you have a lawsuit on your hands. I urge people to stay away from that. I'm not in the collection business.
Right. Now, Jay, let me ask you a question, because I remember one time we had a client who we talked about, patient financing, and they said that they prefer just doing cash based. They didn't want to get involved with any of that. So what are the indicators that a practice is better off staying fully doing cash based as opposed to also offering financing?
I don't know that there really are benefits. All right. In that client's mind, they didn't want to be involved with the financing. They felt that it diminishes the integrity of what they represent. It cheapens their brand. However, there are smart investors and there are smart financial people like us who use our money differently. And I would rather use somebody else's money. Danny DeVito did a movie many years ago, Other People's Money, OPM. All right. And I'm a firm believer in that today. I will always work with other people's money because at the least right now, it's nothing great. But if I put my money at 4% in a money market, and that's not great, by the way, why should I not make 4% if I can get it for free financing? 4% on $1,000 is still what? $40. All right.
Something is better than nothing, right?
I will take $40 and get a free lunch any day. But remember, when you're spending thousands and thousands and tens of thousands, those percentages make a difference. And I would offer it. I always felt that financing was an opportunity that may not otherwise be able to attract those people. And even wealthy people have debt. They may have just bought their home. They may have just had a baby. They may have just had a child graduate college and they're putting a child through college. They may have just bought the child or the grandchild a car. I can go on and on and on. All the wonderful, the niceties, the country club dues are due. All right, now let's go to the not so wealthy people, and they're living under programs that are now being cut by the federal government. So they want the procedure. Now, some people might say, well, if you don't have the money, you have no business doing these procedures. I'm not here to judge that. Everybody should be entitled to do as they so choose and let their priorities guide them. It's not up to us. I had a patient care coordinator. Actually, it was her last day after I heard this. Actually tell somebody you should be spending your money on your children and not on having your breasts redone. All right.
Wow.
Now, I understood why she said this, but that's not her place. She was trying to be a good Samaritan. However, you need to go work at Goodwill, not here. All right.
Yeah, don't scare my patients away. What are you talking about?
This is a business. And if you can't handle the business at hand, you need to be in another business. So I don't think there's room for you here.
Mm-hmm. That's right. No, it's very, very true. And I think that in general, this topic is very interesting for our listeners because you have to make choices in your business. You have to decide what you're going to offer. And I would say that the more options you can give a patient to say yes, the better off you're going to be. You don't want to give them options to say no. So that I would definitely have fired that person too, Jay.
It's the power of objection. Look, there's two fears when it comes time to booking surgery. The fear of pain and the fear of the money. All right. With good surgical intervention, we can share to the patient that it's discomfort. All right. We can try to use that word pain. Take that away. The fear of the dollar bill, we can help to offset that by offering options that are both advantageous to the patient and to the practice.
Even we like to offer options as consultants to our clients. That's the same for your practice. You got to attract them somehow. And once you have them, you got to keep and retain them.
Look, it's not a whole lot different. We finance our clients. For example, if you have an annual agreement with us, we don't tell you have to pay it all up front. It's an annual agreement and you pay it by the month. So we're basically financing you. However, if you pay it in full, then we give you a premium. We either give you a month free or we'll give you a bank of additional hours equivalent to another month. And if you're going to do that, quite frankly, it's a whole good tax write-off at the end of the year. It's not a selling point, but that's financing. And for those of you listening out there, When it comes time for you to be on the other side and you are buying capital equipment and it comes time for you to finance, try to bring in a third party for multiple reasons. Number one, I negotiate every day, each and every day, because I know the bottom line price better than you do, regardless of what a salesperson will tell you. Additionally, there are multiple financing options, and I want you to be all listened carefully. Many people will know this, but many people, when I share it, had no clue. When you are offered 6 months of $1 or $99 a month, and you're borrowing $50, $75, $100, $200,000, and you're paying $99 a month for the first 6 months, I want you to understand that all of that interest is still accruing. And on that 6 month and a day, the 181st day, all of that interest that you didn't pay is now encapsulated into a new principal, and you will now pay on that new principal. So all they meant was there is only $99 payment, not that the interest, it's deferred. It doesn't mean that it's eliminated. So truly, if you really going to buy something, and I urge you people out here, it might be the best investment you ever made for a couple $100 for a consultation to get somebody to help you negotiate it and help you negotiate the financing. Understand that many times the companies that are offering you the financing, the capital equipment vendors, have their hand in it for a couple of basis points. Not all, but many. I'm not always the most popular guy with these salespeople because I'm taking something out of their pocket. But remember, I represent you, not them. So with that, Cristian, thank you so much for allowing me to be a guest on my podcast.
Absolutely, Jay. Thank you for being here with me and spending this time. And for those of you listening, that was a great golden nugget at the end that Jay gave you for staying all the way to the end. So we'll see you on the next episode. Good luck and God bless everybody.
Before you go, new episodes are released every 2 weeks, offering perspective on the decisions, systems, and leadership behind well-run practices. For continued insight between episodes, follow us on social media at Shorr Solutions. This is Shorr Solutions, the podcast.